As we are looking at the market on Sunday, November 9, 2025, regular trading is of course closed. The last session on Friday, November 7, 2025, was an absolute roller coaster for Beyond Meat, ticker BYND. The stock finished the day at $1.39 per share, which was a blistering 16.81% gain from Thursday's close. But that one-day percentage gain is perhaps the most misleading piece of data you could look at, and it perfectly captures the deep, dangerous disconnect between the expectation and the reality for this company. The expectation, if you just glanced at your screen, is that Beyond Meat is recovering. The reality is that this stock is no longer an investment. It is a speculative trading vehicle, completely detached from the collapsing fundamentals of the business. That 16.81% pop, which saw the stock trade in a huge range from $1.13 to $1.42, wasn't about a new product or a sudden surge in profitability. It was the echo of a massive, retail-driven short squeeze that has turned this name into a pure gamble, a meme stock in the truest sense, and it's drawing in traders using platforms like the Robinhood app and SoFi Invest, looking for that next lottery ticket. Here's the insight that 16% jump obscures. Beyond Meat, the company, is almost unrecognizable from a shareholder's perspective compared to just a month ago. In mid-October, this stock was on life support, trading at 50 cents. Then the meme stock crowd, seeing massive short interest, piled in and managed to squeeze the stock all the way to $7.69 in a matter of days. It has since collapsed from that high, and Friday's volatility is just the aftershock. The common belief, the story that propelled this company to its 2019 IPO-era glory, was that Beyond Meat was the next Tesla stock or Apple stock of food. It was going to disrupt the multi-trillion-dollar global meat industry. People saw it as a clean energy, high-growth tech company that just happened to make burgers. That was the expectation. The reality is that in October 2025, the company was forced to execute a debt-for-equity swap to avoid a near-term bankruptcy. This is the part that many traders seem to be ignoring. Beyond Meat had over $1.1 billion in convertible notes due in 2027 that it had no realistic way of repaying. So it struck a deal. It exchanged that debt, not for cash, but for stock. It issued approximately 316 million new shares, giving them to the creditors. Let's put that in perspective. Before this deal, Beyond Meat had about 76 million shares outstanding. This move quadrupled the share count. This isn't just dilution, it's a deluge. It means that the former creditors, the bondholders, now own roughly 88% of the entire company. If you were a shareholder on October 1st, your ownership stake was effectively erased, replaced by a tiny sliver of a much, much larger pie. The company saved itself from bankruptcy, but it did so by handing the keys to the creditors. This makes any online investment in BYND right now exceptionally risky. This isn't a stock you add to a long-term retirement account like a Fidelity IRA or Schwab Intelligent Portfolios account hoping for stable growth. This is a trading sardine. The people who now own 88% of the company are not long-term believers. They are creditors who took stock instead of a total loss and will likely be liquidating those 316 million new shares into any rally, creating a massive, persistent ceiling of selling pressure. That 16.81% jump on Friday was likely retail traders buying while these new institutional owners were happily selling into that strength. And the bad news doesn't stop at the dilution. The business itself is crumbling. The entire plant-based meat category is facing a severe downturn. The expectation was that consumers would try these products, love them, and switch from animal protein. The reality is that a large portion of consumers tried them and decided they didn't like them, or at least didn't like them enough to justify the high price. In an inflationary environment where real ground beef is cheaper, the premium-priced Beyond Burger is a tough sell. We saw this in their Q2 2025 results. Revenue was a disaster, falling 19.6% year over year to just $75 million. They are burning cash at an alarming rate, with a $22.1 million adjusted EBITDA loss in that quarter alone. They have never, in their entire history, posted an annual profit. They were a growth story that has stopped growing, and now we're all waiting for the other shoe to drop. The company was scheduled to report its third quarter 2025 results on November 4th. They abruptly delayed that report to November 11th. This is almost never a good sign. The reason they gave is that they need more time to assess a material non-cash impairment charge related to their long-lived assets. In plain English, that means they have to officially admit that their stuff, their factories, their equipment, their machinery isn't worth what they've been claiming it's worth on the balance sheet. This is an admission that the demand they built all that infrastructure for simply isn't there and isn't coming back. This impairment charge is going to be a big, ugly number that will likely wipe out whatever is left of their book value. This is the critical reality that traders on the Robinhood stock trading platform might be missing. They see a low-price stock like $1.39 and think it's cheap. But cheap can get a whole lot cheaper. Compare this situation to a real growth story, like Nvidia stock, which is dominating its field and growing profits. Beyond Meat is the exact opposite. The analyst community sees this clearly. While the stock has been on its mean-driven ride, the professionals are all backing away. Mizuho has an underperform rating with a $1.50 price target, which the stock is now testing. TD Cowen is even more bearish with a sell rating and a price target of just 80 cents. They see the same reality we do: declining sales, no path to profitability, massive share dilution, and now a pending asset write-down. The company is in survival mode. They are trying to rebrand, focusing more on the BYND name and nutritional benefits rather than just meat replication. But it feels like rearranging deck chairs on a sinking ship. The competition, like Impossible Foods, is still fierce, and the entire market is shrinking. This isn't a sector problem where a rising tide will lift all boats. This is a company-specific crisis on top of a sector-wide demand problem. So what does this company actually do? For those who are new to the story, Beyond Meat was founded in 2009. It designs and manufactures plant-based meat substitutes. Its core products are made from pea protein and other plant-based ingredients designed to replicate the taste, texture, and appearance of animal meat, like burgers, sausages, and ground beef. They sell these products in grocery stores, the retail channel, and to restaurants, the food service channel. The initial excitement was driven by major food service partnerships. But that too has been a story of high expectations and disappointing reality. Many of these partnerships have quietly fizzled out or failed to expand nationwide. The retail channel is also suffering, with sales in Q2 2025 in the U.S. dropping 27.7% as consumers just aren't picking the product up off the shelves. This is not a hidden gem. This is not a buy-the-dip opportunity for a fundamental investor. This is a gamble. If you are a sophisticated trader, perhaps using a platform like Interactive Brokers, which offers more advanced online investing tools, you might try to play the volatility. You might buy at $1.20 and sell at $1.40, but for anyone looking for investment help or engaging in self-investing for the long term, this is a stay-away sign. This is not what Fidelity Investments or SoFi's robo-advisor services would call an investment. It's a gamble that the next wave of retail traders, disconnected from the financials, will bid the stock up for a few hours. Looking ahead, the future for Beyond Meat stock is binary and bleak. The bull case, if you can even call it that, has nothing to do with the company's performance. It is 100% reliant on a short squeeze. It's a bet that enough people on social media will coordinate to buy the stock, forcing shorts to cover and creating a temporary artificial spike. This is what happened in October, and it's what some traders are betting will happen again. This is not an investment strategy. The bear case is everything else. It's the reality. It's the 316 million new shares waiting to be sold. It's the delayed earnings report. It's the coming material impairment charge that will decimate the balance sheet. It's the declining revenue, the negative margins, and the fact that the company is burning through its remaining cash. The fundamental value of the equity, given the dilution and the debt, is likely heading towards TD Cowen's $1.80 target or even lower. The November 11th earnings report will be the next major catalyst, and it's hard to see any good news coming from it. I want you to comment below with your thoughts on the Q3 earnings delay. Do you think this material impairment charge is the final nail in the coffin, or just accounting noise? In the end, the story of Beyond Meat is a classic tale of market expectations completely diverging from reality. The expectation was a disruptive, high-growth tech company. The reality is a low-margin food producer that just traded 88% of its ownership to its creditors to avoid bankruptcy, all while its customers